All right, good morning, everyone. We're gonna get started now that everyone's gotten settled in and got some hot food. And I'm always excited to see the crowd that shows up here. It tells me how much interest there is in the markets. I'm sure it has nothing to do with the breakfast. It's all about the markets. And I'm gonna be a walking contradiction this morning by introducing someone who needs no introduction. I'm not going to spend a lot of time introducing you to Jim, but I do know that, the markets have been a little choppy lately. And typically when it's choppy, people start wondering, hey, what's going on? And Jim today is going to tell you exactly what's going on and exactly where the market's going to go. Am I overselling?
Well, we're not going to be able to have this compliance approved.
Oh yeah, I guess I should give those disclaimers. No, I think you're going to hear some valuable information this morning. Jim's going to walk you through kind of what we're seeing in terms of economic data and how that's impacting the markets. I'm going to come back at the end with some couple of financial planning tips for you. The last thing I want to mention to you is you see the pens and pads on your, I know you're going to want to take a lot of notes because this is gold. This information is gold. But I do want you to know these pens, if you try to write with them and they're not writing, there's a little plastic nib on the end that you might need to eliminate in order for you to take those very important notes. So without further ado, Jim Dunlop.
Thank you. Good morning. I'll start off by asking the question, why don't you ever see elephants hiding in trees? Because they're very good at it. So today I want to share some information on the economy and just share what we see are some really key data points to pay attention to. If you've attended before, you've heard me say that there's an awful lot on the news. It's easy to turn on CNBC and get your blood pressure increasing and get worried and panicked. And I think much of what we see in the media around finance really has little to do with long-term investing. When Jim Cramer's there pushing buttons and making bells rings and things like that, he's giving advice on a stock that he might sell next week or buy tomorrow. And so I don't think that's a really useful for long-term investors. And so today, and part of why we like to do this presentation is to make sure my clicker's working, make sure that we have some better perspective and a little bit longer view on what's going on in the economy. So I want to start off, and often in this presentation, we like to use the S&P 500 as a proxy for the broader stock market. And we're going to do that today, but I would also put a big caution on the S&P 500, and you'll see why here in a few moments. The S&P 500's actually had a decent run this year when stocks in general have not. And so we'll explain what's going on with the S&P 500, but that's more of a short-term phenomenon. From a long-term perspective, we can kind of look at where we've been. And so if we look back over the last 25 years or so, 27 years, you can see that we've gone through several bear and bull cycles, and we're still kind of in between. We're in a little bit of a correction territory, perhaps right now. All the data you're looking at, by the way, was as of last Wednesday when we had to pull the data to get it approved to share with you today. So it's pretty current. A few things have happened. Later today, the Fed will make its announcement on interest rates, and we'll talk a little bit about what to listen for in those comments. But that was just kind of a view of where the market has been. But again, we're not too far off of our long-term highs. We're certainly off of our highs from where we were at the beginning of 2022 when the market peaked, but we're not too far away. It's been a very painful year and a half since then. However, I do believe from a historic perspective, we've still seen a pretty decent run up in stocks. And if we kind of follow this trend line from 2008, we're still kind of on trend with a nice little hiccup in here. And then we look at stock valuation. And so one of the best ways to value a stock is to look at its earnings capability. And so what you're seeing here, this jagged line, is the PE ratio of the S&P 500. And so what that simply means is we know that stocks historically have traded around 16 times their earnings. The S&P 500 averages that. And so that middle line is the 25-year average of stocks valuation. As earnings go up, the value of a stock goes up. As earnings drop, the value of a stock goes down. And we certainly, if we look at the top and bottom dashed line, we would say that's one standard deviation away from normal. And so we like to see this line kind of in the middle there, and that's right where we are. We would say stocks by this measurement are probably pretty fair value. They were probably got a little bit overpriced during the pandemic. We had this experience where markets were very exuberant in 2020, 21, and of course have been pretty negative in 22. And this year now, I would argue probably more on the flat side, but not linearly. So the reason why I think the S&P 500, which is the 500 largest stocks in the United States, and historically it's been a good proxy for the broader market. It's the 500 big companies. But what we'll look at is, if you see here, what's the phenomenon that we're dealing with is 32%. So about a third of the S&P 500 is the top 10 stocks. And those stocks are mostly stocks that would be known to everybody in this room, and they're mostly tech stocks. So very volatile segment of the market. So when we see the S&P 500 is doing really well, a lot of that growth is being influenced by Apple, Amazon, Google, Microsoft, Meta, Tesla, NVIDIA. And so those are, ExxonMobil is probably a non-tech company that's in that group. But all this is to say that there's a very small group of stocks moving the broader market. If we step back and look at the Dow Jones Industrial Average, it's about flat on the year. So it went up, it's come back down. So we'll see that a little more clearly as we go along here. This is a very busy page, but I'll just draw our attention to a few things. When we think about stocks, we like to think about them as a tic-tac-toe board. Stocks fit into 9 categories. We have our big companies, we have our medium-sized companies, and we have our small companies. And then we have our value-oriented companies, we have our growth-oriented companies. In the middle, we have kind of the blended. And this has been a year of haves and have-nots. So if we look at year-to-date, large cap growth stocks, so those companies I just named a little bit ago, with the exception of Exxon, are all large cap growth stocks. They're up 25% year-to-date. If we look at small companies, all negative on the year. Medium-sized companies, maybe the growth are up a little bit, but pretty flat or negative. Large cap value, negative, blended, up a little bit. So really, we have a very small group of companies doing very well that have pushed stocks higher on average. But by and large, we see a lot of stocks that are negative on the year. And we have a couple different time frames here that you can always go back and look at later. If you want to dwell on any of these slides longer, I invite you to do so. We'll be posting after we edit Jamie's comment out about promising what would happen in the future. We'll be posting a copy of this video to our website. So we do hope you're always invited to go back and look at this a little closer. Again, thinking just about stocks and giving us a little bit of perspective on the S&P 500 over the last 43 years. Most years it's positive, but it has lots of negative years. So the gray lines show what the stocks did in any given year going back to 1980. The red dot shows the worst moment of any point during the year. So as of last Tuesday, you can see stocks' worst moment during the year had been 8%. We may have actually passed that at the end of last week, but we're up 11% on the year. And so all of this is to say that when we think about the stock market, the last few years have been painful, but not unusual either. And so as long-term investors, we have to have years like last year, but then we also get to have years like 2021. What I think has been and again, if you've visited with us in person, there's a good chance we've shown you these charts. This is the bond market, the Bloomberg aggregate bond market. And if we look at this again, it's historically bonds are pretty stable. They make money most years. They're down a little bit at some point during the year, hence the red dot. And almost every year bonds were negative at some point, but most years they are positive. And so from that historic standpoint of that, we think about all of that and think, oh, bonds have often acted as a shock absorber. And of course, the last 2.5 years have been very difficult for bonds. And in fact, last year, bonds were down, and hopefully not blocking it, 13% on the year. Down a little bit this year. They've floated around. They've been down a lot earlier in the year. And again, that is a direct correlation to the Fed raising rates. So as interest rates go up, bond prices come down. Now, the good news for long-term investors is bonds are yielding a lot right now. And if the Fed keeps rates stable or even cuts them, that'll be very good for bonds. And we'll show you that kind of probably, if I have to look forward, that's a place where I have probably a little bit more optimism as to what's ahead. But we'll come back to bonds. But I just kind of wanted to contrast, last year bonds, we expect them when stocks are negative, like last year, for bonds to be that shock absorber, and they weren't. In fact, they were negative too. And if we think back to some really tough years in the markets, here's the technology bubble, here's the housing crisis of 2008. We knew that in those years our bonds did okay to help buffer what was happening in the broader stock market. And last year was pretty much like driving a car with no shocks. So stepping back from the markets and talking about the broader economy is, and this is, I think, a place that we like to pay attention. I think part of the reason stocks have been negative, particularly last year, and have been negative here the last 3 months, has been this perception and thought that the Fed keeps raising rates. When they do that, people lose their jobs. We're going to have a recession in the next few months. And that recession has yet to materialize. Economic growth, if we look at the last 20-some years, 22 years, we are on this 2% trend line without a whole lot of interruption. And we're back on that 2% growth trend. Obviously, politicians would like it to be higher. Like we'd all like to see it. But economic growth in this country has continued kind of on that long-term trend, even into this year. And the reason I think that's notable is if you come over to the right side of this chart, is you'll see that 68%, or typically we say about 70% of US economic activity is based on consumer spending and consumption. The stuff we like to have and need to have, and the stuff we want to have. So both discretionary and non-discretionary, everything from groceries to vacations. What I think has been interesting and why we haven't had a recession is we've not had a difficult jobs market. We still have very, very low unemployment. Most people can find work at this point. And so that means consumers have money and consumers continue to spend. And that is the biggest driver of our economy and continues to be. So that is why markets, I think, go through this cycle over the last 2 years of, oh my gosh, we're going to have a recession finally. And then one doesn't materialize. We keep getting reasonable job reports. And again, we'll kind of take a look at that. I think one place that continues to be concerning from a long-term perspective, and I don't ever want to inject politics, but it's just, this is a lot of uncertainty that the market seems to be ignoring now, but at some point I think the market will pay attention to, is our federal finances. So this year, which actually just ended yesterday, the fiscal year, the plan was for the government to spend $6.2 trillion, and we raised about 4.8 trillion. So we had to borrow this year $1.4 trillion to close that gap. And of course, the next few weeks we may have another funding catastrophe. And that could inject some short-term instability in the market if we have a shutdown. But historically, governments reopen pretty quickly after everybody's done posturing in Congress and they they pass some sort of measure and the markets recover pretty quickly. So I don't worry about it in the short term. What I do though worry is kind of the long-term issue of, if we look at, here's kind of that annual deficit. In the late 90s, we did actually have some surplus, but we really haven't been in a place of surplus in a long time. And so all of these years of borrowing add up to the overall federal debt, which sits today at 98% of GDP. And we really have not been in this type of place in terms of that much debt in our history outside of a brief period in World War II. And so we're getting to this. And if we don't change behavior or fix this here, at some point, you know, if 10 years from now, GDP will get to a place where we've never, or excuse me, debt ratios, the amount of debt relative to our economy gets to an interesting place. Now, does it matter? I don't know. Nobody knows. And there are economists that would argue, well, measuring your debt next to GDP is just like saying, well, you have a bushel of apples for every bushel of oranges, but so what? You know, the federal government has a lot of assets. It owns a lot of land. So if you look at the federal balance sheet, we actually, you know, we have about 200 trillion of, or people estimate that the US government is worth 200 trillion. But the real issue is we do at some point probably need to address this. And if the government keeps borrowing, oh, and by the way, the interest on the outstanding debt is now going up, what does that do to our economy? Does it force us to really raise taxes, which could slow the economy down at some point? So I don't know that there's a good solution yet. And parties will argue it both ways, but the math is very challenging, which is why we don't have a solution. If we look at where we spend, we have Medicare and Medicaid, we have Social Security. So half of our spending this year is on those. And I have yet to hear a politician that wants to cut either of these. And then, you know, we have defense. And again, you could cut defense, but very little at a time when you probably need to increase it. And then we get to this little, you know, we get this little purple, what they call the discretionary spending, but it's less than $1 trillion. And even if you got rid of all your discretionary, which is roads and highways and bridges and all the other stuff that we expect the government to help us figure out, you still don't fix that problem. And we're going to pay $640 billion just in interest. So that's increasing. So all of this is to say that, you know, this is not a short-term issue in my mind, but it is something that we will have to address over the next decade, because I think the thought is, we don't know because we haven't been there before, but it could be a tremendous long-term drag on the economy if it's not resolved. So speaking of recessions, again, you've heard me say the markets keep worrying about recessions, and there are 6 things that have to go negative for us to have a recession. Real personal income, less transfers, has to drop. Non-farm payrolls have to drop. Household survey of employment drops. Real consumer spending has to drop. Wholesale and retail sales have to drop, and industrial production has to drop. So the point of this is 5 of these 6 things are directly related to employment in my mind. You know, if you have jobs, you have personal income, farm and payroll employment, household employment, consumer spending is a result of having a job and having money to spend, and retail sales is me spending the money that I earn. We look here each quarter, you know, these things are not negative. They were negative a little bit earlier this year, but, you know, we can go back to the pandemic here just to give you an idea. And we have some red matter through here. It's not bright green, but it's certainly not negative. So what that says is we're still seeing improvements in all these categories, maybe more minimal than we're used to, but we're not close to or on the precipice of a recession. I think a number of things have to start going wrong for us to get there. So the economy kind of continues to expand at that 2%, despite all the naysayers and worriers. And I think if this trend continues, I think that actually probably should be good for stocks, because we'll stay out of and avoid a recession. So those are the things to look at. Continuing on this idea of consumer and the consumer being the backbone of the US economy, let's kind of look at consumer finances. So right now, if we add up all of our, collectively, our assets, minus our liabilities right now, we all have about 100, if we put all our money and our resources together, we have $174 trillion as collectively, and we owe about $20 trillion. And so, that's a pretty decent balance sheet. And so US wealth is still relatively close to its all-time high. Yes, markets are down, so that's down a little bit, but a lot of our wealth is tied up in homes, some in banks, pensions, and then other investments. And then most of the debt is in household mortgages. Now, a couple of things to as we think about the health of the consumer to keep in mind is this upper right-hand chart. And this is the debt service ratio. Basically, how much of our income collectively are we putting to debt service? It got really, really low, during, almost down to an all-time low during the pandemic. And we're still about 9.9, but we're in line with probably the last decade of debt. Certainly not the kind of debt we saw in the 80s and 90s and early part of 2000s, where we were paying a lot more debt. So the consumer's balance sheet is still relatively healthy from a historic standpoint. And I think that's good. If we were to go through a recession, consumers still are in decent shape on average. But if we look down at this right, this is tracking early delinquencies. So this is a little bit of the canary in the coal mine of who's starting to get behind on their payments. And you'll see that on auto and credit card payments, we are having an uptick over the last 2 years. So we're starting to see some people go more than 30 days before they're late on a car payment, they're late on a credit card payment. So that's starting to increase, but again, probably right in line with what we've seen over the last decade. So nothing that's out, but we'll keep watching that trend. And if it does keep going up, then I think that could be concerning. Student loans are kind of weird because, it's a hard measurement to track right now because people have been able to defer their payments for a very, very long time here, or several years. Then we thinking about the consumers, this is looking at the personal savings rate going back to the 1960s. Yes, we are not saving anywhere where we were in the 60s and 70s. But again, we're still probably in this area here. Year to date, we're saving about 4.7% of our income. Not phenomenal, not certainly along with that, certainly well below that long-term average, but certainly in line with what we've seen pre-pandemic and not out of whack there. One of the things, and just as a side note, this data all comes from JP Morgan. And they partner with us because we use some of their investment products. And so they provide us this data actually daily. We can download their data, which is really helpful. But JP Morgan is also one of the largest issuers of credit cards in the United States. So they watch consumer spending trends very, very closely. And they're one of the largest banks in the United States. And so they don't do, personal banking in this part of the world, but a lot of the country, they do, people have their checking and savings accounts with them. JP Morgan a year ago was projecting by June of this year that the way the consumer was spending, that all the savings we had accumulated during the pandemic. So people spent a lot less during the pandemic and they saved a lot more. And we saw that right here, right? And they were expecting that savings could be lost by June of this year, coming into the beginning of the summer, and that might be the first sign of a recession, is the consumer spends all their savings, and now we're either not spending or we're going in debt to spend, neither of which is ideal. But we still are seeing still a historically nice personal savings here as of this data, which was at the end of, I believe, the end of August. Personal savings were still higher than people were projecting. So we're burning some of our savings, but not as much as we thought we would. So that's good. And if we look again at outstanding consumer debt, so if we look at this, as of the end of August, we're at 6.3%, certainly higher than we've been in the last 3 years, but still well below that long-term trend. So the consumer tends to continue to be resilient. And we know that's important because it's part of the, that's a big part of our economic driver. So it's a trend we want to watch carefully, but it's better than anybody expected. And so I think that's one of the reasons that things continue to go okay economically. So real quick, Anybody know why elephants paint their toenails red?
So they can hide the strawberry guy.
And then I'll close, Rich. They like to hide in cherry trees. All right, so let's thinking about the labor market a little bit here. Let's just kind of take a look at where we are. A couple things that we'll look at. Down here are some key labor market things. Again, everybody has been worried that, and there's some historic precedent for this. Look, every time the Fed has raised rates as fast as it has, it's always led to increases on unemployment or job losses. It has not happened or materialized. The Fed started raising rates on March 16th of 2022, and we have not seen we have not seen a dramatic shift in labor markets, and most people expected that we would. Does that mean it won't happen? No, it could. But if we look at all these different things, and I won't go into a lot of detail, but if we look at all these things kind of on a heat map, we're still seeing enough green and yellow here to say that the market's doing pretty well. Yes, and we had a big jobs report in September. Yes, the downward trend here, if we look, payroll gains, meaning jobs added, has been dropping a little, but it's still pretty strong. And then if we look at labor force participation, for the people in that 25 to 54 years old age bracket, labor force participation is close to a decade high right here. And we're starting to see in the age 55 plus, we're seeing a little bit of improvement there. Obviously, during the pandemic, a lot of those folks exited the job market, never to come back, but we're seeing some gains there. So, there's this concern of, well, yeah, unemployment is low because so many people left the workforce. That's true, but a lot have now returned. And certainly almost to the point, except for our 55 plus, going back to the beginning of the pandemic, we're certainly seeing a lot more people participating in the jobs market than we've seen in a while. So I think the people who, it appears, the data appear that the people who want to have jobs and want to work are able to find work. Might not be exactly what they want, but that's certainly there. And then if we look at, again, looking at unemployment, our long-term 50-year average of unemployment in this country is 6.2%. And for many years, the Federal Reserve said full employment is 5% or better, meaning, you're always going to have 5% of the workforce in transition, either looking for a job, quit, fire, whatever. But here we are after all of this, and we're still at 4.3, which is again not a bad place to be. Or did I say that right? Yeah. So you can see, well below our long-term average of unemployment. So unemployment continues to be strong. At the beginning of July, there were still June, there were 10 million open jobs in the United States. We're less than that 10 million number. So people say, well, maybe jobs market's softening, but it hasn't softened dramatically. Then let's talk about inflation. I'm trying to weave all this together because they're all connected. Inflation has been probably the biggest thing that has bothered markets, because what's tied directly to inflation is what the Federal Reserve does with interest rates to combat it. So the biggest tool in the arsenal of inflation is raising interest rates. So inflation matters a lot to markets, and this has probably mattered more than anything else to the stock market in the last 2 years. It has been this inflation rate, because as inflation is high, stocks worry that interest rates go up, and then stock markets like low interest rates for lots of reasons. But again, we had pretty outrageous inflation here in the 70s. And you heard probably 2 years ago, hey, we haven't seen inflation like this from the 70s. And so,
sorry,
that's
involved.
sometimes I activated somebody's Siri. All right. But again, and we look at inflation. The Fed looks at inflation a lot of different ways, but we'll look at two different measurements. There's the blue line, which is what we call headline inflation. That's the price of everything and how has it changed over the last year. And again, the Fed's target is 2%. So the Fed would like to be in this neighborhood here. The long-term average is the gray line, but we are certainly trending downward on inflation. Now, Core inflation, which is the dark line, is a little more stable because we take out food and energy. And it's kind of a mixed bag. We take out food and energy because they're the most volatile things. But then we also spend a lot of our hard-earned money on food and energy, gas, heating our homes and all these things. So, that tends to be a little more volatile. But again, the trend over the last year for both of those categories is they're dropping. I think the issue, and the Fed has been actually pretty spot on since this. Now, early on in the pandemic, they said, oh, inflation's transitory, it's temporary, it'll all go away. It didn't really work out. But I will say the Fed has said, we're going to raise rates this many times, we're going to do it aggressively, and we're going to keep them high. And I suspect the rates will stay about where they are. Now, today, Chairman Powell will speak, and I think the thing that you need to listen to this afternoon, if you want to turn on his press conference at 2 or 2:30, they probably won't raise rates today, though they might. They might raise them again in December. So the consensus is they're probably not going to raise them today, but they'll probably say we reserve the right to do it again at our next meeting, which is in December, which is now next month. So they may say that. But I think what the market will really be listening to is what is the Federal Reserve saying long-term is going to happen? And I think they will continue the mantra of rates. We're going to keep rates where they are for a while, which is high. We're going to keep rates high. And so I think that's what markets will be listening to. Now, if Chairman Powell says something like, well, we're pleased with where inflation is, and we think we're done raising rates, and maybe we can cut them, and the markets would probably like that a lot. I don't think he's going to say that. I suspect he'll continue the same mantra of we're going to keep rates high. Maybe we will or won't raise them anymore, but we're going to keep them where they are for a while. And I think markets have come to assume that that's the case. If you look here, this is just what's making up and driving inflation. Obviously, we saw energy was a huge component. A year ago. Energy is becoming less an issue. That's the green bars. The biggest thing that is driving what I think is driving the inflation rate still, the biggest component is shelter. And so the housing, real estate prices, this is residential, not commercial, is still very, very high, and rents have increased as well. So the cost people are paying for their homes and to live in places is starting to temper, but that is a much slower moving thing. And as rates have gone up, mortgage rates have gone up, it has pushed people out of the housing market. We're starting to see that market stabilize a little bit, but that's going to be the hardest thing for the Fed to move in all the different inflation parts. New and used vehicles was a big concern 2 years ago, even a year ago. That has kind of dropped out of the issue. Used car prices are still pretty decently high, but new vehicles are not. And now we're seeing a glut of EVs and things like that. So it's not clear what impact that will have. So I do think that inflation is looking better, but that's just to give you an idea. So going back to Chairman Powell, there's a couple different things. Here's interest rates over the last, the last 20 some years. And then we have some divergence. If we look at the green line, this is what the market believes is going to happen. And I wish they would overlay the market expectations historically. The market has actually been much better at predicting what the Fed is going to do than the Fed is. And then the Fed is the dark blue, it's hard to see, or purple, excuse me, is what they think they're going to be, where they're going to be here at the end of the year. And you'll notice that as we get into next year, the market believes the Fed will start cutting rates. The Fed believes it'll start cutting rates more slowly. So we'll see what happens going forward. But we don't have it in this presentation today, but they have the dot chart where they ask all the rate setting people to think where they think it's going to be. And then, the bond markets, which trade against interest rate futures, tends to be a little more accurate. But the long-term projection of the market is that interest rates are actually going to be higher in the long run than what the Fed actually believes they're going to be. So that's kind of an interesting dynamic to pay attention to. But the consensus seems to be right now that we're pretty close to the peak. Feds may do one more hike, maybe two. small ones. You might get a better sense of that today. So, but I think that's important because that as interest rates start to either level off or even go down, I think stocks will probably react more positively to that, all things equal. Now, that has been the biggest driver of stocks, but that also could change. We could get drawn into a broader conflict of what's going on in the Middle East. That certainly could take the economic news could be awesome. The interest rate news could be great. The inflation rate could be awesome. And all of a sudden something terrible is happening internationally or domestically that markets stop paying attention to economic data for a little while and pay attention to geopolitical. Hasn't happened yet for the most part. Markets have not been terribly influenced by what's happening in Gaza. We've seen some uncertainty there in stocks that could be tied to that. But again, the markets tend to be more focused on this inflation and interest rate data. Talking about the 10-year Treasury. So the 10-year Treasury is the most frequently cited federal debt, and that's basically 10-year Treasury bonds that people hold, and what are the interest rates on that. And the reason the 10-year Treasury is probably the most studied or closely followed one, it's the risk-free rate. It's the most common thing. That's the benchmark of the safest investment in the world is the US 10-year Treasury. We could have another argument about that, but historically, the safest investment in the world tends to be US Treasuries, and the 10-year is the thing that they look at. So the 10-year yields, the nominal yields are this purple line that goes up, and right now, we're at 4.82%. We even crossed over that 5% threshold for a few days in the last month, which I think spooked markets a little bit. But again, if we look at a historic perspective, we're still on the lower side. We are certainly trending up from where we were at the bottom of the pandemic. And real rates now, for the first time in over a decade, historically, are now back into this positive, which is real yields is the nominal yield or the stated yield less the inflation rate. And for a lot of the last decade, people were willing to lose real money, meaning they were willing to lend money to the federal government for less than the inflation rate, which meant that the buying power of that money was being separated. As people were taking real negative returns just to be safe. That trend looks like it might be ending, although we could certainly duck right back below this 0% line. But I think this is part of what this was what allowed, and I'll put this on both parties, to run big deficits the last 10 years, 15 years, was the borrowing cost for the US government was 0%. We'd issue debt, and we issued a 10-year Treasury at 3%, and people would pay us a 3% premium to buy it. So, essentially, right there, you're wiping out that debt, and so you're getting away with 0% financing on the national debt for a long time. So it was easy to run up debt because it wasn't costing us a lot or much at all. And now that dynamic is certainly starting to change. So that's a phenomenon to look through, and I think that will start to show up more and more in our federal spending because we will have to pay more to borrow. We're already seeing that, and so as our old 0% debt comes due, we're having to refinance essentially at higher rates, so to speak. So thinking about, and this is why I talked about that bond chart towards the beginning of the presentation, and I showed it relative to the stock market. And what we're looking at here on the right is the impact. The blue bars show if interest rates fall 1%, what will happen to debt or bonds? And if interest rates go up another percent, what will happen? And in either case, if the Fed has to raise another rate, bonds aren't going to do a whole lot. They're going to be okay, but they're not going to go down much more unless you're holding 30-year Treasuries, long-term debt. That would not be a good place to invest right now. The blue bar here shows that if the Fed starts cutting rates, I expect bonds to do very, very well. It's suggesting that if the Fed raises or lowers rates 1%, then the U.S. ag could go up 11. We could see double-digit returns in bonds, and we saw this in 08, 09. You know, the Fed cut rates right back to zero during the housing crisis. They had been gradually raising rates, cut them back to zero. And bonds did incredibly well at a time when stocks were hemorrhaging, probably the worst they've hemorrhaged ever, going back since the Great Depression, I should say. And so this is at a place where my outlook on bonds is pretty good right now. Like, it's kind of a heads I win, tails you lose, meaning the market has already built in, the bond market has already priced in most of the damage that can possibly happen. Now, if the Fed raises rates 2 or 3%, which I don't think is going to happen, but it's always possible, then I think this. But if we look at that chart a couple slides ago, the consensus is the rates are either going to stay where they are, which means bonds are going to do, we are now holding higher yielding bonds that are doing better, so that the yield on those bonds is good. So even if the bond prices don't change, they're earning a nice coupon. However, if they start cutting rates, not only will we be earning that higher coupon, but we'll also see the value of those bonds go up. And it's this idea, think about it like a CD. If I have a CD that's paying me 6% right now, and they cut interest rates, boy, that 6% CD looks and feels really good if I walk into the bank and I can only get a 3% CD. So you know, that just kind of gives you an idea of where we are. So my outlook on bonds is, I think we've seen all the burning and dying that we're going to see there for the most part, but we could be wrong. And what would make that wrong is if the Fed really had to raise rates in a rate that was very, very difficult. Thinking about the yield curve, again, this is another reason why markets, I think, have been uncertain. Every recession we've had has been preceded by an inverted yield curve. And the yield curve has been inverted for a while and continues to be inverted. And the idea of inversion means simply that I can make more on short-term bonds than long-term bonds. So if I were lending the government money for 3 months, they're going to borrow it at 5.6% from me. But if I was lending it to them for 20 years, they're going to borrow it at 5.2%. Now, this isn't highly inverted. You know, we're only 0.4% off these two numbers here. So it's not terribly inverted like it maybe was before. But this is probably a more normal yield curve. I'm rewarded for lending the government for a longer period of time than I am a shorter period of time. So, but again, every recession we've had has been preceded by an inverted yield curve. Now, I would also say the yield curve has inverted itself and we've not had a recession. So they're not a cause and effect, but it's certainly, it can be one of the canaries in the coal mine. So markets have fixated on this dynamic. I would say what we're seeing now is the yield curve is starting to really flatten out. But again, if I were lending the government money, i.e. buying some treasuries right now, I'm going to buy 1 to 2 years versus lock up for 20 and less. But also there is some merit in saying, could 5% over the next 20 years be acceptable rate of return for a lot of investors? That may be. So we'll continue to watch that dynamic. There's a lot of been talked about just thinking and bringing all this data back to normal investing. We talked about the 60-40, and if you've listened to this, the 60-40 phenomena is common to long-term investors. So I think it merits a conversation, and that is the average portfolio of an investor in the United States is 60% stocks, 40% bonds. Now, if you're more aggressive than that, it's more in stock. If you're more conservative, it's more in bonds than this. But the moderate or average investor is probably in that 60-40, maybe 50-50. And so this was always a really good tried and true strategy going back to 1950, that this was a strategy that delivered most times because, again, that 40% bonds was that shock absorber in a really difficult year for stocks. And so, but stocks drove a lot of that growth. That's the green that you're seeing. But last year, again, was very painful. And this year has been painful too. Bonds have not done a whole lot this year. They're maybe a little negative. Stocks, if you're looking at just the S&P 500, are doing okay. But last year was really painful, and one of the most painful year for average investors because it was one of those rare times, and you'd almost have to go back to 1967 to see a year like last year, where both stocks and bonds were horribly negative. So even though the stock market wasn't as negative as we've seen in the last 2 bear markets, it was exacerbated by a really challenging market. So there was a lot of news saying, oh, 60-40 is dead. That this strategy for investors is no longer apropos. And last year, yes, every now and then we get a period of time where stocks and bonds are positively or are correlated together, acting in the same way. But historically, they don't. And I think that trend will continue, that they are still diverse investments. But last year, you had fear of recession really pushing stocks down, and you had dramatically increasing interest rates pushing bonds down. I don't know that you're always going to have those two dynamics. In fact, typically, again, the fear of recession pushes interest rates down, that pushes bond prices up. And so stocks go down because of recession, but bonds historically go up. But we never got that recession, so that dynamic really didn't come to roost. That said, if we still take the long-term view on 60-40, it's not a bad deal. And what you're seeing here is you're looking at stocks compared to bonds, compared to that 60-40 blend. And those are the 1 year worst case scenario is that 60-40 lost 15% since 1950. So last year was one of the worst years for that portfolio. But still, 1 year of that portfolio has made as much as 33%. Now, if we look at a 10-year average, you can see that the range is between 16 and at least 2%. So 60-40 still, even in 5 and 10-year rolling periods, still is a very positive strategy. And then just thinking too, like contrasting what's going on in CDs and interest rates in different periods of time. So again, thinking about peak 6-month certificates. So this is where we are right now. So CDs are at their all-time high. Could they go higher? They might. So what happens is right now, investors are sick of stocks. They're sick of bonds. And they're saying, well, geez, Jim, I can go to the bank and they're going to promise me 5% or 6% in my CDs. Guess what I'm going to do? And that's fine. But every time we've gotten to this before, going back to the 80s, the next 12 months, S&P 500 delivered this green bar. Now, 2000, 2001, that didn't come true. The bond market certainly did better than that. And then the CDs are, these where you see this. So my point is, CDs look very attractive right now. But if we look at a historic standpoint, typically when CDs start to peak and interest rates start to peak, the following 12 months tend to be, not always, but typically tend to be good for stocks and bonds. I think it's just helpful to have that information as a long-term investor. So my last question is, what's the loudest noise in the jungle? Giraffes trying to eat cherries. All right. We have some, I love a good dad joke, and I love the groans when I tell them to my kids or my spouse who can't stand them. So I tell them only for my own entertainment. So we have some really good fine print that you should go back and read. This will be posted online. But most of what you're seeing in this fine print that I think is worth noting is a lot of definitions of all the different indices that we used. I've tried to point those out as we go along. And then things that we have to disclose to you, but you can't possibly read this here, but go back online and you can slow it down and read all this, is that, past performance is not indicative of future results. So those are the things. But before we conclude, I do want to just wrap up with as we come into the end of the year, I'm going to invite Jamie back up here, who's my business partner, just to share a planning idea as we head into the end of the year. And we'll certainly entertain any questions after that.
So I don't know which our compliance department would be more offended by, my joke about, prognosticating the market or Jim's dad jokes. We're going to get an email. Just cut it out with jokes. Just cut it out. I do want to give you some financial planning tips to close today. But before I do, I did want to make one comment about some of the data that Jim shared. He talked a lot, spent a little bit of time on our federal budget. And, kind of the imbalance between income and expenses and the national debt. The one comment I wanted to make is if proportionately your budget looks like that, we should probably have a conversation. Because that's not likely sustainable in your personal budget for the long term, so. So 3 estate planning ideas for you to be thinking about is what I want to share today. And I want to start with a question. You've probably heard about the strategy of gifting money to family as a way of reducing your estate or reducing estate taxes. Everybody heard kind of that concept before? Right. Some of you may be even doing that today. So my question is this. How many of you know how much you can give away before you start getting taxed on it? Every year.
17,000.
17,000. Everybody heard that number?
Yep.
Yeah, for 2023, 17,000. For 2024, 18,000, and it tends to change over time. Now, I'm going to back up a little bit and tell you that was actually a trick question. There is a misperception in this area by a lot of folks. I asked, how much can you give away before you get taxed? If you give away more than 17,000, that doesn't necessarily mean you pay tax on it. I want to explain that because that is a misperception for many people. The $17,000 is what's called the annual exclusion. It's basically the IRS's way of saying, hey, we want to give people the opportunity to give some money away every year. So I can give 17,000 to every one of you. I'm not going to, but I could give 17,000 to every one of you, and the IRS would be fine with that. If I go over that 17,000, that does trigger a different scenario, but it doesn't trigger tax. The IRS also has, we all have what's called the estate and gift tax lifetime exemption. And that number is currently around 13 million. It's likely in the next couple of years to drop in half. And that's, by the way, 13 million per spouse. And so what happens is if you go over that annual exclusion amount, if you give more than that in a given year, you're starting to use up that lifetime exemption, and you are supposed to file a gift tax return to tell the IRS that that's what you're doing, but that's just an information return. That's not actually triggering any tax, okay? So I just wanted to share that with you. You do, if that's part of your estate plan and you want to give more than that, there are ways that we can do that and we can talk about that. But that is a common misperception. Oh, I can give away this much, but then I got to worry about taxes. No, you don't. You just have to worry about maybe filing some information. Okay, does that make sense to everybody? So that's
Lifetime exemption.
what's that?
Lifetime exemption? Is that
Yeah. You have an annual exclusion and a lifetime exemption. By the way, if you're married, you both have that exclusion and you both have that exemption. Okay, so just something to think about. A second one, how many of you, and if you don't want to disclose this, it feels too private, you don't have to, but how many of you have a joint account with a spouse? Okay, I have one. So joint accounts are great for convenience, for access by both spouses, but they're not ideal from an estate planning standpoint. Does anybody have any idea why that would be? Anybody ever heard of step up in basis? We're going to get into some real nitty gritty tax stuff. It's fantastic. Anybody heard that term, step up in basis? Basis? Okay. So basis is simply, I buy a stock for $100. I sell it for $150. Basis is what I bought it for, or the tax, the number upon which the gain is calculated. Okay. So if I bought it for 100, my basis is 100. I sell it for 150, my gain is the $50, right? So if let's say I have an individual account and I put $100,000 into it, and when I die, it's 200,000. So I have $100,000 of gain in there, right? And it's an individual account. I leave it to my spouse. She gets what is called a step up in basis, which means if she had, I gotta use my hands. If she turns around and sells that, the gain is 100,000, But if she inherits it from me and then she turns around and sells it, her basis isn't 100,000. It's the 200,000. The basis steps up to the value at the date of death. So she pays no gain. Does everybody understand that? She pays no tax on the gain because assuming she sells it on the date of death and the value hasn't changed. She pays no tax on that gain, even though if we had sold it during my lifetime, we would have. So why would a joint account be any different? Well, in a joint account, we each own half. So if I passed away, we only get half of the account stepped on a basis. And her tax, she might actually end up paying a little bit more in tax. I will tell you very practically, this occurred, my dad passed away in 2017. And my dad was not a stock market investor. To my knowledge, he never invested a dime in the market. But he owned a lot of real estate, rental properties, he flipped properties. And he and my mom, or he owned them in his name. But when he got sick, and before he passed away, the attorney suggested, hey, you should probably change those into joint. It'll be easier for the property to transfer over to your spouse, which legally makes sense. Unfortunately, the CPA wasn't in the room at the time. And if the CPA were in the room, he would have said, hey, time out. What that means is instead of paying zero tax, she's going to pay tax on half of that gain. And that's exactly what happened, which in their case was a pretty significant check. So again, pay attention. If that alone is not a reason why, joint accounts aren't bad and individual accounts are good. But if you have a joint account and there's substantial gain in it and you're concerned about estate or tax implications at your death, that might be something to talk about. Okay. So that's, again, these are just things to think about and to be aware of. And if you want more conversations with any of the advisors around here, we can talk with you about that. And the last one I want to share from a estate planning standpoint, sometimes people have a hard time figuring out, okay, when I pass away, who's the best person to serve as executor? Maybe maybe I've got a couple kids, maybe I don't have kids, and so then I'm not sure, or I've got kids, but I'm not sure, well, it should be one or the other, should they both do it? Or you have a trust and you're not sure who should that trustee be? If I make this person the trustee, that's going to create these relationship tensions. So if you ever have an issue like that, you can consider a corporate trustee. And a corporate trustee is in essence a more neutral party who can, either help administer the estate or administer a trust from a more neutral stance and take some of the emotion out of the equation when there might be multiple parties involved. And so that's something that, that's not always relevant. It always is good to have a family member involved. It's more common now to have what's called a trust protector. Has anybody heard that term before? Trust protector is basically a family member who's charged with ensuring that the trust is working the way it should be without actually being the trustee. So if you have a corporate trustee, you might have a family member who serves as a trust protector. And this is probably a good time for me to give an important disclaimer that we, Jeremy, Chris, Jim, myself, we are not attorneys. We are not, well, I am a CPA, but I don't practice as a CPA. We're not CPAs. So any of these items that you're thinking about, we certainly should be involving your attorney and or your CPA in them. But these are just things that you might want to consider as it relates to your specific situation. If you haven't looked at that in a while. By the way, if you haven't looked at your estate plans in a while, go out to our website on the Education Center. There is a free tool out there for estate planning considerations. It's just a checklist, a yes or no checklist that you can kind of go down through and see if there's anything that maybe you should be considering from an estate planning standpoint. If there's anything there that should be reconsidered, we can talk to you about that as well. Okay, just want to give you some tips to think about if estate planning is something you haven't revisited in a while. And I will open it up for any questions.